Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really honored to have with me Lyn Alden. She's here for a second time. I think probably a lot of you are aware of Lyn. She seems to be gaining a lot of traction, and for good reason, because she provides, I think, a lot of great insights into not only what's happening in the markets, but why things are taking place as they are, and that's the kind of person we'd like to have on this show. We don't want to just know what's going up and down, but why, what are the reasons, so that we can prepare for the future and try to understand the markets as best we can. So Lyn has a background as an engineer, and it's just quite an incredible background. She's also been very active in advising, in financing, and managing money and so forth. So she has had a lot of coverage in the mainstream media, Forbes, MarketWatch, Times Money Magazine, the Daily Telegraph, The Street, CNBC, U.S. News and World Report, Kiplinger. It goes on and on. So we're really pleased and honored to have Lyn with us again. And I should mention again, it's lynalden.com, Lyn Alden, ALDEN, Alden.com. To catch up with Lyn, and she does provide a great deal of very heavy-duty, I would say, substantive free stuff that you can take advantage of. She also, though, does charge a very reasonable amount for advice that she passes on for investors as well. Lyn, thank you so much for joining us again.
Hey, thanks for having me again. I appreciate it.
I really am glad that you can be with us because I know that it's interesting. We have a son who's in his early 30s, and he started to get interested in investing, but I was a little surprised that we mentioned, my wife and I, when we talked to him last weekend, that, he knew your name. So that was,
nice.
That was pretty interesting. He's out in California, and we don't see him that often because we're here in New York City, but in any event, we talk to him every week about it and more about investing. So, Lyn, most pundits on CNBC and other mainstream financial media, as well as politicians, both parties actually, they seem to focus on COVID-19 as a major reason for our current economic malaise. But you did a great job, I think, in pointing out what I think was a canary in the coal mine back in September 2019 when you explained why the repo market rates surged suddenly up to about 10%. Necessitating the need for the Federal Reserve to start pumping money into the system again. Could you perhaps talk a little bit about the mechanics of that? What happened then? And then to what extent is it still an issue or isn't an issue now? And to what extent might have that been telling us something about the systemic issues that we might still be facing now? I don't know. I want to hear what you have to say about that.
Yeah, absolutely. In any sort of recession, I think there's a lot of media coverage around the catalyst, right?
Yeah.
Because that's the most newsworthy or a headline part, especially because this was an unusually kind of noteworthy catalyst. So there's a lot of media attention on it. But the work I've been showing is that there's a lot more meat kind of behind that, which is the amount of debt in the system. And so, a lot of financial indicators saw this coming, even though, of course, they couldn't fully see the pandemic coming. So, for example, the yield curve inverted, like before the pandemic hit. We had slowing GDP ever since the end of 2018. So, we were already kind of in a deceleration phase. And so the pandemic kind of hit us while we were already somewhat weak. And so the work I did on the repo crisis last year showed that basically we're getting to the point where, we've had so much debt built up in the system, especially on the sovereign side at this point. So federal debt that, there's not a lot of private buyers for that debt. So, for example, the foreign sector has not really accumulated too much treasuries in the past 5 or 6 years, and the domestic balance sheets are pretty saturated by that. So what that essentially means is that if the Fed wants to keep interest rates low, they have to gobble up a pretty significant part of ongoing treasury issuance at this time. And that's something we saw. It began, they were trying to do quantitative tightening, but starting with the repo crisis, they had to quickly reverse that and begin, increasing their balance sheet, buying more treasuries. And of course, that was pre-pandemic. And then they've had to accelerate that, during this, global slowdown and recession, especially in March and April. They had to buy a ton of treasuries, and then they're still just, they're buying like $80 billion or so a month currently in treasuries.
Mm. Wow. So the problem, if anything, has gotten worse. It means more stimulation. Not stimulation is the wrong word, I think. Just more liquidity needs to be pumped into the system to keep the system from imploding.
Yeah, so one of the ways I characterize this is to show that most people are aware of the short-term business cycle, which is you have leverage build up, and then there's some sort of catalyst or something happens, and you have a deleveraging event, right? So you have kind of malinvestments worked out of the system. But because of the way our system works, as soon as we have a deleveraging event, we have a lot of fiscal stimulus and a lot of monetary stimulus. They lower interest rates, and that kind of short circuits the deleveraging event and encourages the system to re-leverage back up. So over the course of multiple short-term business cycles, they never really deleverage back all the way down. So they deleverage like half the way, and then they start building up from there. So if you string a bunch of those short-term business cycles together into a multi-decade secular trend, you get higher and higher debt as a percentage of GDP, and you get lower interest rates until you hit the zero bound. And so that's what happened, of course, back in 2009. We hit the zero bound. We had extraordinarily high debt, and that's still in play over a decade later now. And if anything, more of that debt got up to the sovereign level because we bailed out the private system a decade ago, and that all a lot of that got up to the sovereign debt level. And so now we went into this crisis with already having federal debt as over 100% of GDP.
Right. So you have lower and lower rates because the system can't tolerate higher rates. And the deeper into this multi-short-term cycle you go, like the more of these short-term cycles that pile on top of each other, the lower the rates go, the higher the debt is. And so interest rates don't go back up just simply because the manipulation by the Fed. You would think that if there's a shortage of money around, if the Fed didn't keep pumping, that rates would go up. You'd have a very severe recession, perhaps, or maybe not that severe if you left it happen on an ongoing. If you weren't involved with manipulating the monetary system on a regular basis, perhaps you would have these little tiny, cycles, adjustments, I should say, with rates going up. Or do you think that that there's something systemic about it? That there's nothing that. In other words, what I'm trying to ask is it the result of the Federal Reserve or central banks in general that cause or exacerbate the pileup of debt on top of each other because they don't want to allow, or the politicians don't allow them to let the free market, adjust naturally?
Yeah, I think it's a blend of fiscal and monetary policy. And so, looking at interest rates in particular, it's a self-reinforcing loop. So, lower interest rates allow for more debt accumulation, but as debt goes higher and higher, it makes it impossible to raise rates. So it kind of pushes rates down, and that of course allows more debt accumulation, and that keeps happening until you reach the zero bound. I think, decades ago, monetary policymakers could have gone in a different direction. For example, under Greenspan, they could have had less dovish monetary policy, and that could have prevented some of this debt accumulating as high as it did. However, because of the path they chose, the challenging thing now is that they're so backed into a corner, right? So now, no matter who you put in charge of the Fed, it's kind of like just a set of bad choices to choose from, right? Because if they're never going to be in a situation where they let, say, the sovereign just nominally default, right? Because all banks around the country hold treasuries as part of their risk-free collateral. So if you had a treasury default, you would have a default of the entire banking system, which would be systemic. So because of that, they're into that corner. They essentially have to make sure that the treasury market stays liquid, but that comes with its own kind of downside, which can be currency devaluation, negative real interest rates, and all sorts of things like that. So it's really tough because they had choices decades ago, and now they have very few choices.
There are very few choices left. But in the article that you wrote about a century of fiscal and monetary policy, you really outlined the difference between these short-term debt cycles and then the one that accumulates, the cumulative one, the one that happens every 80 or 100 years or so, I guess. And so it really has, as you say, there's not many choices left. So how does this thing play out?
Yeah,
and how do you think it will play out? Because as you point out in your article, monetary policy becomes less and less effective, it seems, as these cycles pile on top of each other.
Yeah, so in a normal business cycle, you can deleverage nominally if you let it happen. And the problem is when it gets exacerbated into a long-term debt cycle. So you build more and more debt up, and then interest rates get lower and lower. And when they hit the zero bound, that's when you have a long-term debt cycle play out. So, ever since 2008, 2009, we've been in this zero or near zero environment. And like you said, the last time that happened was about 80 years ago. Starting in the early 1930s. That was the last time we were persistently at the zero bound. And so, what happens in that environment is that monetary policy kind of runs out of ammo. So that, their interest rates hit the zero bound. So then they turn into creating bank reserves to buy assets. Notice quantitative easing today. But that doesn't get money into the hands of the people. That doesn't encourage banks to necessarily lend more because they're already kind of levered up. So historically, when you get to the long-term debt cycle, that's when fiscal policy usually takes over and gets more aggressive. So fiscal policy, politicians start usually running much higher fiscal deficits. And so usually what happens is instead of deleveraging nominally, you end up deleveraging in real terms by devaluing currency. So when you have kind of a massive amount of debt relative to GDP or relative to money supply, and because it's a fiat system, they can essentially expand the monetary supply significantly. So what we've seen this year and what we've seen 80 years ago last time this happened is you have a very rapid increase in the broad money supply. And so you end up deleveraging debt relative to broad money without ever actually decreasing debt. But of course, the downside to that is anyone holding cash in a bank or holding sovereign bonds or other kind of low yielding supposedly safe assets can lose a lot of their purchasing power. And that's it's a very challenging time for investors in this environment because stocks are highly valued, but then they ask where they're going to go. And if they look at the bond market, bonds are giving you negative real yields. So their yields are lower than the underlying inflation rate. And so there's not a lot of safe havens, especially in kind of some of the most mainstream assets for investors to flock to.
Yeah. No place to go, no place to run, no place to hide. It seems where you can really go, and normally you would go into treasuries in these other earlier cycles and get a reasonable return at least, maybe and then you can come back out and buy stocks after they've bottomed out at some point and make a lot of money that way. But it seems as though the system itself is now in some deep trouble. And so we had Roosevelt back in the 30s and the public works programs and all those ways. And now we're seeing massive numbers of people who are having difficulty paying their rents. We're having the CDC, for whatever reason, I don't know what gives them the authority to tell people they don't have to pay their rents to landlords. And landlords certainly have to pay their mortgages to the banks, I would think. And you would think that somewhere along the way, there's going to be some big trouble unless there is a lot of money that's created out of nothing and pumped into the system, right?
Yeah, that's kind of the two choices they have. They can either let kind of a big nominal collapse happen, right, because there's so much debt in the system, and the middle class at this point is pretty insolvent because we have a very high degree of wealth concentration. So I think a lot of people look too much at debt relative to income, but they don't separate out the different kind of income quintiles, right? So a lot of the assets are held by the top 10% or so, whereas a lot of the debts are actually in kind of the lower groups. And so for the average person, their expenses have gone up a lot more quickly than their income, which has made it very difficult to save, and they've ended up taking out a lot of debt in many cases. So they're kind of in a situation now where they're stuck between, if they don't do stimulus, they're likely to have more bank failures, they're likely to have more civil unrest, likely to have kind of weaker corporate profits, and then of course because our system is kind of very influenced by money. A lot of those corporate, CEOs and investors are donors, political donors. So politicians are under pressure by them. So both from the public in terms of civil unrest and from the investor class from donors, there's not a lot of kind of inbuilt incentive to not do stimulus, other than kind of political gamesmanship. But if when they do stimulus, of course, then the offset of that is usually get more currency weakness. It's kind of like just choosing between different ways to kind of deflate a bubble, naturally, whenever they kind of have control over the printing press, they usually try to go the printing route.
The easiest way out, it seems.
Yeah.
Well, then you talk about, we're seeing these riots in the major cities, a lot of destruction. some loss of life at this stage by a couple of groups, Antifa and Black Lives Matter. What I hear you saying is there's probably some, not necessarily what is being sold as the reason for all this, but there's probably a lot of other deep-seated issues of anxiety throughout, especially younger people who are having difficulty coming out of college, paying their debts, and finding jobs and so forth. But I'm wondering if have you read the fourth? I'm guessing you've read The Fourth Turning.
Yes, yeah, I've actually mentioned that in a couple different podcasts too. And if you look back in history, so the long-term debt cycles, they're all fourth turnings. That kind of big kind of debt buildup and deleveraging event generally comes with a pretty big societal shift at those points because it's a very polarizing period every time it happens.
Yeah. So it's like every 4 generations or so. So it's an 80 to 100-year period. So the last one was the 1930s. I guess before that, we would have been looking in U.S. history. We would have been looking at the Civil War, maybe. And yeah. So these are big. This is a big event that we have, I think, playing out here. What are I listened to Ray Dalio recently talking about. The question was posed to him on Bloomberg whether the dollar could be in trouble, and he says, yes, I think it could be in trouble. There's no other currency to go to right now. But people are going to gold. They're going to things that will save value because certainly you can't go to treasuries to save value. The real rate of return is negative there, and maybe inflation starts to rise a little bit too because you've had some supply chain issues related to COVID. Perhaps maybe some more coming. People unemployed. They're not producing anything, but they're getting paychecks. What this looks like could be a lot of issues ahead. What about the dollar's future? How do you see that? And inflation? Do you see potential for rising inflation? And given this fiscal stimulus, it's going to be accommodated with monetary printing, obviously.
Yes, my base case is to see kind of a more multipolar currency reserve world, which means that the dollar could shift from being the global reserve currency to a global reserve currency, which meaning like one of several. And one example to look at is that 2 years ago, the trade between Russia and China was about 85% dollars. And over the past 2 years, they've significantly de-dollarized down to about 45% dollars, and euros have taken the lion's share of that difference. And so that's not to say that the euro is going to replace the dollar because the euro has its own problems. But what it means is that, instead of all global energy, for example, being priced in dollars, it can be potentially priced in a couple different major currencies. So Russia's been pushing to try to price energy in euros. And China's been interested in kind of being able to price commodities outside of the dollar system. So I think starting from some of those countries that are like less friendly to the United States and that are less pleased with kind of the monopoly that the dollar has on global commodity pricing, you kind of see it start from there and spread out. And I mean, to some extent, that's a return to how it's been in the past, because even though there's for centuries there's always been a global reserve currency, it's actually been, this is an unusual period where one currency is used to price like all commodities worldwide. So that's a very unusual period, and so I think we're kind of shifting away from that period because the U.S. is no longer for one, it's no longer the biggest commodity importer, that's China, and two, just it's as the world's gotten kind of bigger and more interconnected. They have more opportunities to try to, have a more multipolar system. And if you look back over the past 5 years, central banks have not really been buying treasuries too rapidly. In recent years, they've actually been increasing their exposure to gold a little bit. So in that sense, kind of those currencies become medium of exchanges, but they're not necessarily the store of value. So central banks kind of they might price things in dollars, but then instead of continuing to build treasury on their balance sheet at least at the rate they have been, they can look at other sort of neutral settlement assets like gold.
Well, certainly, China is supposedly the world's largest gold producer, and they don't export gold. Russia's a large producer. Both of those countries have been building up gold too. I would imagine they're doing what a lot of private citizens are doing, the Ray Dalios of this world, and yourself and a lot of us that have been buying gold or gold-related assets, realizing that, not that gold is going up in value, but that the currencies are losing their purchasing power. So I guess it's hard to predict how this will play out, but as you say, that you can just watch and see that the dollar is losing its influence, its prominence, I guess, as a currency, as a primary currency, I guess. Well, so Lyn, I guess what can we take from this in terms of our own investing? I was suggesting just now, I guess I made a suggestion that gold and silver and tangibles. But what about the stock market? I mean, you're not just a gold bug like I'm more of a gold bug, sort of a philosophical Austrian school belief system. But you are very practical. You're a scientist and you're an engineer. What are you doing with your investing in general terms now? And I know that you do provide specific information to your subscribers, to your paid subscribers, as well as provide a lot of free stuff on the internet. But if you could, with the last 3 or 4 minutes that we have here, just tell us sort of what you're doing in your investment world.
Sure, yeah. So, the best investments kind of shift over time based on valuations and different areas of growth. So, for example, I turned bullish on gold and silver and their miners back in 2018. So we've had that as a pretty significant chunk of the portfolio since then, and that's been one of the best performing areas. But at the same time, of course, we've also had very good performance from some of these growth stocks. So, for example, we've had companies like Adobe or NVIDIA in their portfolio that have recently actually had to trim because they've gotten so expensive and so highly valued. So it's kind of a curse, right? If an investment does well enough, sometimes you have to trim it from the portfolio. So, sure. I don't go all into gold and gold stocks and silver. I incorporate that as a part of the portfolio. So what I do is I look at a blend of individual stocks and sometimes ETFs as well. So I rotate out of stocks that I think have become overvalued. I get into other stocks that I think are offer kind of better risk-adjusted returns, taking into account their growth rate, their valuation, any dividends they might pay, their balance sheet strength, things like that. So I'm still finding opportunities in U.S. markets, but they're kind of they're not very abundant just because markets in general are pretty highly valued, especially compared to the economic damage that's currently happening. And looking abroad, I think that there are some opportunities internationally as well. Those markets tend to be a little bit cheaper. And they've of course had like a decade-long period of underperformance relative to U.S. Stocks. So many of them are at somewhat more reasonable valuations, and there are kind of trouble spots to avoid. But overall, I think that there are pretty good international equity opportunities. And then also, I've been increasingly looking at some of the base commodity space. So we've been interested in the copper producers, some of the beaten down oil producers that are actually kind of really strongly positioned. Ones with less debt, that have tons of reserves, that have low cost of production. Because they can outlast some of the weaker shale companies and things like that. So by basically having a pretty diverse portfolio and then kind of shifting towards areas of value. And then it is somewhat controversial, but in April we added a small Bitcoin position as well to some of the portfolios at around, I think it was just under 7,000 of Bitcoin, and so that's been a pretty good bullish move from there as well. So
very good.
Yeah.
Yeah, that's very interesting. And tell, with 30 seconds left here, tell our listeners your service, because you outline all of those ideas, of course, in your paid service, right?
Yeah, so that's available at lynalden.com. I have tons of free material, but I also have that paid premium service for any investors that want to get some more specific information. Ideas.
Yeah, they're very good. Lyn, thank you so much for being with us. Very interesting ideas that you pass along, and an understanding of the markets. It's greatly appreciated, your time. All the best to you, and thanks again for being with us once again.
Yeah, thanks for having me. I really appreciate it. It's been fun.
You bet.